Welcome to another edition of Focus on Alternatives, an educational series from ADISA, the Alternative and Direct Investment Securities Association. At ADISA, we're committed to providing insights and thought leadership on alternative investments. My name is Greg Mausz. I'm your host for today's episode, and I'm pleased to be joined by Rizwan Ibrahim. Rizwan, thanks for being here today.
Thank you for having me.
It's been a pleasure getting to know you over the years here at the ADISA meetings. But as I was looking over your bio, I just want to say this out loud for the audience. So you have a CFA, you have the CAIA, and you also have the CFP. So you're one of the most credentialed people that we've had here on the podcast. What led you to get all of those designations?
So in my earlier career, I was a management consultant. And I was a partner at some of the leading firms. And I had an interest in finance as a result of that work. And there came a time in my life when I said, I need to focus on that finance aspect. And that's when I went back and got a master's in finance. And I figured that the best way to really understand investments, which was really my area of interest, is to go through the rigor of a CFA program. And that was my first intro into the world of investment management. And then I figured that I would like to focus on alternatives, and that's when I got my CAIA designation. And then, lo and behold, CFP was like in the side also, and I said, well, might as well do that. So I guess it's a way where I, said to myself, let's go back to the basics and learn and figure out what this is as professionals do. So hence, the focus on the three credentials.
Well, I think it's great because, we can never be good enough professionals when we're serving clients and we're dealing with their money. Outside of a person's doctor, their financial advisor is one of the most impactful people post-50, and having the quality of life that they want and whether or not they can achieve their dreams or help define the legacy that they have. So the role of the financial advisor is amazing and so important. But today we're going to be talking about alternative investments. And, they're becoming more and more commonplace, which is great. But people hear, I like this particular strategy or I like this particular outcome, but they don't know what to do next. So the title of this episode is, I like an alternative investment, but now what? Can you walk us through kind of at a high level how we coalesced around this title?
Well, if you think about it, as human beings, we walk in a mall and we see something flashy and we say, how do we get it? And the question should be, do I really need it? And so when you think about, we are at a conference here at ADISA, you could be at an IPA conference, you could be at a third-party due diligence event. And as financial advisors, we come across a lot of attractive products. And there's a narrative sometimes that you like. There's a feature of the product that you like, and you say, hey, I want to have this. But that's where we make, I think, our first mistake. Because in my opinion, it's more about, do I need that product? And so that was really the reason behind the title, which is, rather than be product first, let's talk about what is your need as a financial advisor. And what's our need as a financial advisor? We serve our clients, and we try to create outcomes for them. And alternative investments are a means towards that end. And so if we don't know what our portfolios need or require for a given client outcome, how do we know what we are looking for?
Very true. Let's look at alternative investments over time. We've seen institutions, endowments use them for decades and use them successfully and amassed huge amounts of wealth through the use of alternatives in private markets. Now you're seeing more and more people in the wealth management channel and RIAs access private markets. But what's the thinking of an institutional mindset and an approach to alts, and what's the thinking that you're seeing right now in the wealth management channel?
So again, back to the thing I said earlier, which is portfolio construction comes first, which is really a function of what your need is. Product selection comes afterwards. And so if you think about institutions, what they focus on is what is it that they are trying to do in their respective portfolios. And so their focus is, let me figure out what the outcome is that I'm trying to satisfy. It could be income, it could be growth, it could be both income and growth, it could be diversification of a given portfolio, but the need has to be expressed first. And once that need is expressed, then you go look for the managers and the products that actually can satisfy that particular need. So I guess if you think about institutions, they have a formalized process to do all this. And so as we think about the challenge that RIAs are faced with today, I would simply say that perhaps there are two systems that RIAs need to structure in their practices, which are similar to what institutions do. One is a very formal portfolio construction process, and the other is a very formal alts management system. And so when you think about how you actually use alternatives in a portfolio, you have to make sure that you understand what a particular product is doing inside the portfolio and manage those two separately.
I want to drill down into something you said. You talked about portfolio construction and income need. These days, there's a lot of different options out there. There's real estate options, there's energy options, there's private credit options, and all of those things can be kind of allocated to in various structures. How do you go about picking which ones are going to be used to meet the income need for that client?
Right. So I think when you go back and look at the portfolio need for a client, there may be income needs, there may be growth needs, there may be income and growth needs. And the question is over what time frame that income need is there in a portfolio. So if you are thinking about retirement, and let's say retirement is 10 years out, now you have the ability to actually go and look at alternative investments and say, hey, I'm going to take advantage of that illiquidity premium that's available in alternative investments and go and plan for that portfolio. Now, whether you put it into private credit or you put it into real estate is a function of what your asset allocation looks like. And then you talked about structure. So structure also matters. Now, if I am in a closed-end fund and it has a 5 to 7 year time frame, that matches my liabilities, which are really in the future. So if you think about the retirement need that I talked about. So that's a match, right, between the duration of the asset and the income need on the part of the client. But if I have needs over the next 3 to 5 years in terms of income, and I put my client into a product that doesn't have any liquidity in that time frame, that's a mismatch. So I think it's more, you have to think about when you need that income and then figure out what product and structure will actually support it.
Fantastic. So I've seen some implementation of alts be amazingly successful, and I've also seen some things go sideways. What do you think are some of the biggest mistakes that advisors make when introducing alts into client portfolios?
So again, back to planning, right? So in our case, what we try to do is figure out what the wants and needs are of a given client. And let's say you break their needs into maybe 3 buckets. There's the initial bucket, which is you need income to live your current family life or what have you. Then there may be a retirement aspect, and then there may be a legacy aspect. And so when you think about how you actually mix and match different products, whether it's on the public side or on the private side, or whether it's in a real estate asset, it depends on where you want to have that given outcome. So it could be in your income needs, it could be in your retirement needs, or it could be in your legacy needs. And so what one does is you try to construct a portfolio to meet those 3 buckets, and you mix and match, if you will, public and private investments in order to meet those liabilities in those respective stages. And so for us, it's more about, can you match the duration of the assets in which you are investing in with the liabilities that you have in a given stage? So that's how I would look at it.
I very much appreciate that perspective. When I've seen successful alt allocation, I see diversification around asset class, but that liquidity timing as well. And I know that some structures, your money's locked up for 5 or 10 years, where other structures could provide quarterly liquidity. So it's not only the mixing of the asset classes, which perform differently at different market cycles, but it's also the various liquidity options because you don't know what life is going to deal you. So you need that flexibility, and you make lots of small bets. You'll have different alternative investments coming to maturity at different points in time. So it gives you that opportunity to reallocate based upon the current client needs.
Right.
Rizwan, in investing, manager selection is always critical, but I think that it may be more critical in private markets than in public markets. What are your thoughts on that?
I agree 100%. I think the dispersion of manager performance in private markets is extremely high. And so when you think about a top quartile manager and you compare their performance to, say, the median or the bottom quartile, in private markets you can see up to 1,000 basis points difference. And obviously that depends on the asset class you're looking at and what time frame you're comparing them to. So in private markets, it's very important that your process actually looks at that as part of the due diligence, that you can actually understand that performance is going to be a function of the manager you select for a given asset class.
Okay, I want to focus in on RIAs specifically. And when I see them beginning to allocate to alts, I see them doing 40 Act funds, maybe some REITs, maybe some BDCs, but I see them kind of steering clear of Reg D investments. They're fearful about the illiquidity of it. How do we get advisors comfortable with the illiquidity side? Because having that longer time horizon can oftentimes have a greater alpha in total return.
I think the way I would look at illiquidity is that it's a planning feature. So you have to plan for liquidity in any given portfolio. And so if you do that, then the illiquidity premium becomes a benefit. Most of us tend to get into a product, and then you find out that there's a gate, and then you cannot exercise the liquidity that you wanted out of that particular product. But I would, again, back to my initial discussion about financial planning and the 3 stages. So you should allocate to a closed-end fund if that duration matches the stage in which you are actually planning to get the benefit of that particular fund. And so illiquidity is a feature. Obviously, these days there's a lot of focus on evergreen funds and the concept of semi-liquid. But when you are in private investments, you're either liquid or you're not liquid. And so sometimes what happens is you may think you have liquidity, but the provisions may not be available to you at a time when your liabilities on the client side actually require that. And so it's back to the planning function. So you have to take liquidity constraints into account as you actually figure out what type of products, what managers, what asset classes you're going to actually assign for a given portfolio.
And I want to drill deeper into that, specifically around alts that have some tax advantages to them. So specifically 1031 exchanges and QOZs. Those 2 sectors of investments are pretty illiquid. How are you seeing RIAs engage with them?
Well, in terms of QOZs, I think obviously the tax advantage are plenty. I mean, when you think about investing in a real estate venture and then getting obviously some tax advantages up front, but also over time, all the capital gains are free from taxes. It's a very attractive feature. But again, I would go back to, okay, it's a 10-year plus product, so let's not focus on liquidity from that product. Let it play out and make sure that you get the benefit over a time frame where you actually need that.
Completely agree.
Yeah.
We've seen a lot of money flowing into alternatives. What is that right allocation amount? Some people will be like, hey, we're at such small percentages, and other people are trying to allocate 50% of people's portfolios to private markets. Where is that right allocation?
I think what my observation is that there's a lot of misallocation. I mean, when you step back and you say, okay, what do private investments provide for a portfolio? And if you look at the asset classes, you look at private credit, you look at private equity, real estate, infrastructure, there are so many features in those asset classes that you can use in a given portfolio. And so one has to focus on those features and over what time those asset classes actually yield results, and use that in a portfolio. So over allocation, I feel like sometimes we get into this notion where private credit is offering double-digit yield returns, right? So we get very attracted to that because, hey, my real estate fund is not giving me the distribution that I want. And so that's where you get into the risk of over-allocation, because now you are chasing yield as opposed to figuring out whether that asset class, whether that asset type is actually needed in your portfolio, and whether you have the ability to actually manage the risk aspect of that particular investment. And so I think it's more back to the planning thing. You have to allocate according to what your needs are and avoid the fact that you actually get into things because they're shiny and because there's a problem in another aspect of your portfolio.
Yes, and you've been using alts for 10 plus years. As we wrap up our time here, what do you think a well-run alternative program looks like inside of an RIA practice?
Well, back to what I started with, Greg, which is our business as a fiduciary for our clients is to ensure that we can get them the outcomes they need in order to manage their respective life priorities. And so when I think back about what a RIA needs to have in place in order to support that, especially as you embark on alternatives, it's back to what I said earlier, which is you need to have a robust alts management system, which is integrated with a robust portfolio management system. And if there's anything we have learned from institutions, it's they don't go chasing after shiny objects. They figure out first what their need is, which is a function of what their client needs are in their respective portfolios, and then you go look for the product and the manager that actually satisfy that. So again, I think as RIAs, our focus should be on what we are trying to do for our clients, and then go look for an appropriate product to fill that need.
Right, absolutely. Understand what you're building and then go find the tools. Don't see a fancy tool and then figure out what to build with it. So last question, what's one thing that you want every RIA listening to walk away with today?
I think the emphasis that when you think about alts in your practice, you have to think about the long term, and you have to think about creating rigor in the processes that I talked about, both how you source, screen, and do your due diligence, and more importantly, how you actually put it together in a portfolio for your client. And I think there, one should not be shy in terms of, okay, where are you going to derive that capability from? The important thing is to understand that you can get your institutional level of rigor, and then the question is whether you decide to do that internally or seek some support from outside. But at the minimum, you have to make sure that you have the robust system, both to look at your alts and how to use them.
Rizwan, thank you for sharing all this perspective. I believe the audience is really going to appreciate your wisdom. Thank you for listening to another episode of Focus on Alternatives. For more resources and information about alternative investments, please visit ADISA.org. Stay tuned for our next episode coming soon, and don't forget to like, share, and subscribe to ADISA's YouTube channel.